It wasn't a trade dispute, it wasn't a diplomatic signal, it wasn't even a routine portfolio rebalancing, it was a structural exit. The arithmetic is merciless. When a creditor nation realizes the debtor cannot pay in real terms, the strategy shifts from accumulation of paper promises to the acquisition of physical reality. Current data suggest a massive rotation. China is shedding U.S. Treasuries and aggressively importing silver. This is not an isolated event. It is the recurrence of a historical cycle, a pattern that has destroyed empires before. The pattern is unmistakable. Dominant powers overextend, they debase their currency to cover the gap, and the rest of the world rushes for the exit. We have seen this exact sequence 3 times in modern history. Consider the Spanish Empire under Philip Seyr in the late 16th century. Spain controlled the global reserve currency, the silver real, but imperial costs were unsustainable. Wars in Flanders, defense of the Mediterranean, the bureaucracy grew bloated. To fund it all, the crown relied on debt and the influx of New World silver, but they didn't produce, they consumed. By 1598, the currency was being debased with copper. A Castilian wool merchant, once the envy of Europe, found his savings worthless against the rising price of bread. The middle class was hollowed out. While the elite moved wealth into land, the empire defaulted 4 times in distinct succession. The paper promises burned, only the physical assets remained, just like the Spanish Empire. Weimar Germany faced an unpayable debt burden. The year was 1923. The constraint was war reparations. The incentive was to print. The Reichsmark lost its tether to reality. A factory worker in Berlin, paid twice a day, would rush to buy coal or bread before the noon shift because the currency would devalue by dinner. Foreign nations stopped accepting the mark. They demanded hard assets. Coal, timber, gold. Those who held paper lost everything. Those who held physical silver and industrial commodities survived. The mechanism was a flight from credit to tangible value, just like Weimar Germany. The British Empire faced the twilight of its currency dominance from 1914 to the 1970s. Sterling slowly lost its place as the world's reserve. The turning point came in the post-war era. Britain was drowning in war debt. The United States held the leverage. By 1967, the Prime Minister assured the public that the pound in your pocket had not been devalued. The arithmetic said otherwise. A London bondholder loyal to the crown saw the purchasing power of his gilts evaporate. Nations that held sterling reserves began to dump them. They swapped fading imperial paper for US dollars and gold. The hegemon shifted, the debt was repriced. The pattern repeats in 7 distinct stages. Stage 1 is the era of sound money, where currency is backed by hard assets and production. Stage 2 is overextension, where the state's ambitions exceed its tax revenue. Stage 3 is the turning point, where the government chooses inflation over austerity. Stage 4 is the onset of debasement, often hidden at first by manipulated statistics. Stage 5 is the flight to assets, where smart money exits the currency. Stage 6 is the crack-up boom, a period of chaotic volatility and rising nominal prices. Stage 7 is the inevitable reset, where the currency is either revalued or replaced entirely. Just like the British Empire witnessed the flight from sterling, we are now observing the early phases of Stage 5 in the US dollar system. The current data regarding China's aggressive accumulation of silver suggests a strategic calculation. They are not merely buying a commodity, they are exiting a liability. The incentive is clear. If you hold trillions in debt from a nation that is printing money to pay the interest, the rational move is to swap that debt for industrial inputs that cannot be printed. Silver is essential for solar panels, electronics, and military hardware. Treasuries are merely claims on future taxation. Some economic historians note a counterargument. They claim that China cannot dump U.S. debt without destroying the value of its own remaining reserves and crippling its export economy. They argue the interdependence is too strong to break. This view ignores the fundamental shift in incentives. The risk of holding the asset now outweighs the cost of dumping it. Under the constraints of escalating sanctions and yield curve control, the rational actor accepts a haircut on the paper. To secure the physical, China is prioritizing resource security over portfolio value. They are converting abstract wealth into strategic dominance. The arithmetic dictates that when the debt to GDP ratio passes the point of no return the creditor must liquidate, history offers three potential endgames. The first is controlled decline. This mirrors the British experience after Bretton Woods, where the currency slowly loses purchasing power over decades, eroding the middle class but avoiding total systemic failure. The second is chaotic collapse. This resembles the French assignats of the 1790s or Weimar in 1923, where confidence evaporates, overnight supply chains fracture, and the currency goes to zero, necessitating a total political overhaul. The third is reset and restructure. This occurred in 1933 under Roosevelt and 1971 under Nixon. The rules are rewritten by executive decree, gold or silver is revalued, and the debt is effectively defaulted on through inflation or legal redenomination. The only variable is timing and pain. Subscribe to the channel. Focus on education and resilience. Watch the flow of physical metal, not just the nominal price.